for someone who's listening right now. They're young. Let's say it's like an orthopedic surgeon, big buffed dudes, big buff women. They want to get out there and they're like, I'm going to work for the next 30 years. Disability, what are you talking about?
Most people don't like talking about insurance because you're talking about your own vulnerabilities, and it's always something that happens to somebody else. When you're younger, you feel invincible. But when you're younger, what you do have is you do have your health. And that's when you need to get your policy. You're not likely to get more healthy as time goes on, and you're certainly not going to get younger. So the most ideal time to get a policy is when you are young.
Folks, your exciting new medical career, it's just been hit with a serious illness or injury that stops you from earning a paycheck just when you need it most. Check out what Jamie Fleischner of Set for Life Insurance said back on episode 176 about having disability insurance early in your career.
The real reason to get it early on is really twofold. One is to protect your insurability. So if you are healthy and you can obtain the coverage, you also pre-approve yourself to be able to buy more in the future. So down the road, as your income does increase, you don't have to answer additional medical questions. All you have to do is show that your income is increased and you can buy more benefits at that time. No medical questions asked.
Protect your income, secure your future. Check out setforlifeinsurance.com. So Renee, now that we are here, for me, it's official 12 years practicing on my own, finishing fellowship. Mm-hmm. For you, it's what, 20?
14. Get out of here, Nee.
How many years?
It's not 20.
Okay.
It's 14.
14 years. Half of that as an employed doc. The other half as an independent contractor, locum tenens.
It's not even half and half.
It's more now?
Yeah.
Yeah, you might be right
locums.
about that.
Yeah.
You might be right about that. So I'll be really honest with y'all. When I finished residency, when I finished fellowship, for me, money wasn't my strong point. It was my weakest point. And I just went through med school and just hoping that, once I become a resident, like we're going to make some money, like $50,000 is like, I'm a millionaire and so forth. But when I started to realize going through, residencies that, look, I got bills I got to pay, I got a mortgage I got to pay, and all of these different things are kind of chipping away at how much I'm actually bringing home. Mm-hmm. And let's just say I was house poor, which meant I was spending more than half of my paycheck on a mortgage, probably a house that I should not have gotten. But this is 2006. You know what I'm saying? Everybody could get one.
That's a different discussion for a different day.
Yeah. But towards the end of my training, I got introduced to someone who introduced disability insurance to me, mm-hmm. as well as life insurance. Yeah. And I'm not going to lie to you, I came in it with like blinders on and initially very resistant because I was just like, look, man, I don't have enough money to go around.
Right.
There's no more money to go around. I checked the website of Morehouse and they offer disability insurance. Why are you talking to me about this?
Right. You were employed by Morehouse at the time.
Right.
Yeah.
Right.
Yeah.
But they made a really compelling point as to why I should get it. And before I mess it up, let's just say like it went through one ear, it made sense, and it went out the other ear. I signed up for disability insurance. And since then, I've had disability insurance. But throughout the years, I think we've both gotten a bit more savvy about things. The way how I look at it is like, look, like you spend 4 years, or for some of you who are pre-meds, like you're going to be spending the next 8 years mm-hmm. taking out loans, putting out a large investment on becoming a doctor. But one thing that you never think about is what could happen to you if you get sick, if you get into an accident.
Absolutely.
Or in general, something physically or mentally happens that you can't practice anymore.
Right.
And you need some protection from that. The question is how likely is it going to happen to you? Right. And do you want to play those games?
Yeah.
And I think that's one of the things that I think more physicians, residents, people who are coming out of training, they struggle with, because they're like, well, I'm healthy, I'm going to practice for the next 20 or 40 years. But it's those little things that you don't really think about that could really trip you up and cause a big issue down the line and stuff. So
a one-time catastrophic event could be it, certainly.
Yeah. And at least from your perspective, there's multiple things, Mm-hmm. Obviously for me, it's, men in general don't take care of themselves. That's why I married you, so you can have my back. There's also some of that crazy behavior that men kind of do. We like to jump out of planes
Right,
more so. We
right.
get on motorcycles and things like that. But I'm generalizing. But with women, there's childbirth.
Yep.
There's a whole bunch of other issues that we
Yeah.
can get into. But the most important thing, folks, is that we work as locum tenens docs. We're independent contractors. We do our own thing. So we work really hard. But one of the things that we have and we don't roll without is disability insurance.
Right.
And depending on how you look at the screen, the woman up above, like almost like this is the Brady Bunch, right? Like I think she's above, or maybe depending on how the video's done, maybe here
Maybe
or over there. We don't know if she's below. But either way, we have Jamie Fleischner, who low key has kind of helped us get out of debt. She didn't know that, but she helped us get out of debt. So I had I had a disability insurance plan that was very expensive. And it probably was something that I didn't need.
Yes, this was well before we met Jamie.
Oh, yeah. Oh, yeah. Oh, yeah. So what we found out is we were spending way more on our disability insurance and life insurance. More of the combined amount that we were paying on that was more than what we were putting towards our student loan debt.
Yeah.
It was crazy. So we met Jamie Fleischner. Jamie Fleischner runs SEP for Life Insurance, and we've been affiliated in some form or fashion for over 12 years. She is an independent broker of disability insurance, life insurance, works with professionals, works with a lot of professionals in the medical field. And I think our relationship has changed, right? Like we initially started off, you're like, look, I just got to get out of the most expensive plan and get me into something that makes more sense. To Jamie, like, Renee is pregnant.
Yep.
What does that mean for her disability insurance? To, hey, Jamie, we're no longer employed by our hospital anymore. What does that mean for our own disability insurance? So without further ado, Jamie Fleischner, welcome to Docs Outside the Box.
Long-time friend.
How you doing?
I'm doing great. That was a great introduction. Thank you for having me.
You literally were the first person that we talked to kind of figure out, okay, we need to be better with how we're spending money. And you helped us get a plan that made sense for us, as well as a big plan for Renee, because Renee had that, I forget who you had, but I remember there was
for disability insurance. I forget the company I had. Yeah.
Well, and it's
at one point I had who you had. Yeah.
So your situation is actually more typical than you realize. So a lot of times people do come to me and they've had either bad advice or they're working with somebody that didn't have their best interest in mind. And so sometimes people say, oh, I already have that. I don't need it. Sometimes it's still really good to assess what you have to make sure it's still appropriate. So it's important that you have it, but you also don't want to overspend on it. Like you said, you had a lot of student loans, you had all these other things, and it was holding you back from your overall financial health. So it's really important to just assess where you are initially and then grow with it. And you're both a really good example of, I mean, I've been doing this for 3 decades now. And as things change in your career and in your life, you also need to reassess your insurance, because where you were, 12, 14 years ago is very different than where you are now. I mean, you've got those little kiddos and you have all these other obligations and other types of needs, and your income has changed and your situation has changed. So it's really important to not just make sure you have the appropriate insurance, make sure you're not overspending on it, but also make sure you're monitoring it and looking at it as your situation changes.
Yeah. I mean, I guess if we send people for colonoscopies every 5 to 10 years, we should probably do our own financial colonoscopy.
That's right. I mean, I do have people who come to me and they haven't reviewed things, and then they have a claim and they say, oh man, the amount of benefit I have isn't even going to cover my mortgage. They haven't kept it up to speed. So it's really important that it stays up to speed with your situation.
Wow.
Can you set the stage? Like, let's talk about, like, for someone who's listening right now, they're young. Let's say it's like an orthopedic surgeon or someone who's about to go into orthopedic surgery. And most of them, big buffed dudes, big buff women, they want to get out there. And they are young and viral, and they're like, I'm going to work for the next 30 years, disability. What are you talking about?
Right.
So
I got all this stuff. Like, talk to us about that.
So most people don't like talking about insurance because you're talking about your own vulnerabilities, and it's always something that happens to somebody else. You're in the hospital and your
Right.
patients don't
Right.
think, they never thought they were going to be the ones that needed surgery, or it always happens to somebody else.
Exactly.
And so when you're younger, you think about your future and you feel invincible. But when you're younger, what you do have is you do have your health. And that's when you need to get your policy. So when you initially get a disability insurance policy, they will ask you medical questions, head to toe, last 10 years. You're not likely going to get more healthy as time goes on, and you're certainly not going to get younger. So the most ideal time to get a policy is when you are young and you're healthy. You can answer the medical questions, and then you don't have to worry about it. So if you do decide to jump out of airplanes, like you mentioned, or ride motorcycles, or you develop an illness, or you have some kind of surgery, you're completely set. You don't ever have to answer those medical questions again. So when you're young, that's the time to get it, especially during residency, because there's special residency discounts. So if you're able to get that on the policy, you're going to save even more money over the course of your career.
So for the folks who have, like, not for the folks, everybody, for the most part, their hospital, their residency is going to provide some sense of disability insurance, right? Like hospital acquired, right?
Yes. So most of the time when you are in residency, they will provide you some kind of policy. And when you go work elsewhere, you will have some kind of policy. I'd say 90% of people supplement in some way. There's several reasons you want to supplement. First of all, the policies, so the policies provided through an employer are one size fits all approach, and they can't individually select. They can't say, me and Renee, you're healthy, but Joe, he's got all kinds of health problems. They can't discriminate. So they have to cover everybody. So it's a higher risk pool. So it's sort of a generic plan. So most group policies say you have to be totally disabled, not working, as opposed to an individual policy. Your policies say if you're sick or injured and can't work in your medical specialty, you're covered even if you can work in another specialty or occupation. That's called own occupation. So that's a huge difference. So in your case, again, something happens if you can't do surgery, you're going to get paid even if you can do your podcast, even if you can teach, you could do research, you're going to get paid regardless.
Right.
Whereas if you're only relying on the group policy, they're going to say, oh, you're able to earn income elsewhere, we're not going to pay your claim. So that's one of the things. Number two, a group policy has limits. So typically, they're really more intended for rank and file employees. So the higher your income is, the less your benefits are going to replace your income. They usually have a maximum of 10 to 15,000. If the employer is paying for it, that's taxable. So if somebody says, oh, well, I have $10,000 from my employer, if you're in a high tax bracket, guess what? That's going to really only be about 6,000 a month, or depending on where you're taxed, 5,000 a month. So it really
is more expensive.
Exactly. And then the last reason is most people don't work at their same employer their whole career. So if you leave, you can't take your group policy with you. If you want to go and do locum work, or you want to have gig work, or you want to start your own business or anything else, those policies don't go with you. So let's say you're 40 years old, you've worked out in a hospital all these years, didn't have your own policy. Now you want to leave, but you just had back surgery, or you're now type 2 diabetic. You're kind of out of luck. You may not be able to go get your own insurance. So that's why you want to have some supplemental insurance that's going to cover you more comprehensively. And it's also portable. So if you have that portable policy, you can leave the hospital and then just say, okay, here's my new income. It's gone up. They'll allow you to increase it without any medical questions.
How expensive because that's another thing, residents going to be like, look, this is a risk that I'm going to have to take because it's too expensive.
Yes.
Right? That I'm sure they give you that. Like, yeah, I hear what you're saying. Everything you say makes sense. I can't afford it.
So
talk to us about that.
Yeah. So what I recommend for residents is just get a minimum size policy. You can get like 1,000 a month, 2,000 a month. And you can also just have the kind of premiums that are called graded, where they gradually increase each year. So it might only cost maybe $50 a month or something pretty minimal. So you can get,
really?
Yeah. So it's just a minimum tiny policy, because then when you finish and you leave and you start getting your big paycheck, then you say, okay, now I want to go from 1,000 a month to 10,000 a month. Now we can increase the policy. Again, no medical questions asked. So the goal is just to protect that insurability, and then you don't have to worry about it in the future.
Yeah. So you talked about that minimal policy. Does that minimal policy, let's say you're done with residency, you've paid, $100 or $50 per month, does that necessarily protect you from having to then get reevaluated to see whether or not you need to get that larger policy. In
That's-
other
So
words,
yes.
are
you
you
get residency as a third year. Now you're like in your second year of being an attending. You still got that same old policy. Do you have to
Exactly.
get reevaluated?
Nope. As once you get
Mm.
your policy, they only evaluate you initially. Once you get it, you'll never have to answer questions again.
that's the key?
So you can eat
That's the
sugar
key.
in between everybody. You can get diabetes.
That's right.
You can break your leg. They still gonna cover you.
That's right. Or even like the activity, like a lot of the activities. I mean, I'm in Denver. A lot of people ski and they say, I don't even want to get
Ski.
my policy
Yeah.
till I don't want to go skiing until I get my policy. You know, we've had so many claims, people just falling on the mountain, you know,
Mm.
so just go through the process once and you never
Yeah.
have to deal with it again. Now we do have there's something relatively new in the industry that's called guaranteed standard issue, that we are one of the partner brokers in the country that have this available. And it's only available at select hospitals through select brokers, but it allows residents to get a policy with no medical questions asked. So the
Mm.
benefit of that is, especially if you already have health issues, maybe you're type 1 diabetic, or again, you had back surgery or something, you can get a policy, no medical questions asked. Now it will
Mhm.
limit how much you can increase it in the future, up to 15,000. For a lot of people, that's totally sufficient. And sometimes in some circumstances, it's a little bit more expensive, but it's a really great option. So when our clients come to us, we look at it and say, wait a minute, you have some health issues. Don't worry about it. We can get this policy for you. And that's a big deal.
Because aren't there some pre-existing conditions that could potentially stop you from ever getting a policy, even as a medical student or resident? Talk to us about what happens in those cases.
Yes. So when you apply for insurance, they will either turn you down or put an exclusion on a policy for a pre-existing condition, or they're going to accept you. So now let's say you apply first and either get turned down or get an exclusion. You're no longer eligible for that guaranteed issue. So if you do have some health issues, you
Mm.
want to talk to us first, and we can discern maybe you get that first, and then so you can at least get the coverage. So typical exclusions, probably the biggest one that we see is mental health, like mental health. If you've
That's what I want to
taken,
talk to you about.
yeah. So that is huge, and it's becoming even bigger.
Mhm.
I'd say probably, at least in my anecdotal experience, probably about 1 in 3 physicians is on some kind of ADHD, antidepressant, some kind of medication. So if you're currently taking that, they will exclude that from your policy. And that's pretty typical. It doesn't preclude
When
you
you say
from,
exclude, when you say exclude, what does that mean? Exclude, like
so meaning they will not cover mental health claims. So if you go on a
okay.
claim for depression, anxiety, addiction, they won't cover that if you have that
Mm.
exclusion on the policy. So if you don't have that exclusion, they'll cover it just like any other condition.
Mhm.
So now
Mhm.
it doesn't mean it won't cover Alzheimer's or neurological. It's psychological. That's not covered. Because a
Right.
lot of people have that question too. They say, oh my God, well, what if I get dementia? What if I have
Mhm.
MS or something? No. That's all covered, just like any other
Gotcha.
condition. So, but that's a
Gotcha.
really typical exclusion.
No matter where you are in your career, you've seen patients your age or younger get seriously injured, have a long-term illness, or even have a mental health issue that affects their ability to work. Now, what if that was you? No, for real, what if that was you? Without disability insurance, how are you going to replace your paycheck? In episode 176, Jamie Fleischner of Set for Life Insurance explains why the best time to buy disability insurance is during your residency.
Most physicians acquire their disability policies during residency, and there's several reasons. First of all, when you're younger, you're able to obtain the insurance because they ask you a whole host of medical history. And so you usually don't get healthier over time. Usually you get less healthy over time. So when you're healthy, it's easier to acquire the coverage. Number two, it's also less expensive because it's based on your age and your health. You're not getting younger or healthier over time. So you're at the ideal time. The earlier you get it and the younger you are, the less expensive it's going to be.
So whether you're a resident or you're an attending, it's never too late to protect your income. Renee and I, we use Set for Life Insurance to find a disability policy that fit our needs and budget. So what are you waiting for? Check out setforlifeinsurance.com. Once again, that's setforlifeinsurance.com. Here's one that I think a lot of people don't think about, IVF. What's the scoop on that?
So if you get your policy, pregnancy is covered, just like any other medical condition. If you're put on bed rest, you still have a 90-day waiting period till it kicks in. but it's covered. Now, if you're applying and you're freezing your eggs or you're going through IVF, they're going to exclude pregnancy. However,
Whoa.
yes. However, look at me. However, if you get a pregnancy exclusion on your policy after you give birth, you can just apply to take that off. That's really not a big deal. And when you think about it, of all the exclusions, I think pregnancy is probably the most benign because you're pregnant for 9 months. You have a 30-day wait. You don't find out. The maximum amount of claim is probably 5-6 months anyway. So, but it does also cover any kind of complications at delivery. So if you have, I've had a couple of people who've had claims, they've been out for like 2 years after having major complications at delivery. That's all covered too. So if you're going through fertility, they're going to exclude it. If you get your policy before, you don't have to even disclose it later. You can even be pregnant when you increase your policy. They don't need to know it.
I think I was pregnant when we.
Well, you had your plan.
I had my policy
before you got pregnant.
Yeah.
You know, we encourage now docs to, with mental health becoming more of a acceptable thing to seek treatment for publicly, at least. We're encouraging more people to either see a therapist, speak to someone. Any of those type of things. Like, let's say you don't go on medications and so forth, but you're like seeing a therapist or.
That's usually not a problem. That's usually not a problem. I do tell people in those cases, sometimes you're better off just paying out of pocket, not running it through your insurance.
Jamie, let us know why. Why? Talk to us.
Talk
about that. Come on now.
And use
now we get into the good stuff.
Use a different name. No, I mean, sometimes people do that because so many people want to go and seek help.
I got a feeling Jamie has done that with restaurants too. You be doing some dine and dash in Denver?
No comment. So, no, but I mean, so sometimes so many people want to seek help just for getting through normal life stuff. There's nothing wrong with that. Now, if you're just, I've had clients who, they had a spouse die or they've had some just trauma or something and they're getting help. That's usually not a problem. If you've been taking medication for a long period of time, they're probably just going to exclude it. So that's just, now this is better than the way it used to be 10, 15 years ago. If you'd ever taken medications, they would just decline you. They would just turn you down. And I don't think that that's right. I personally, what I've seen, I think people who actually do seek treatment and do get help are probably mentally better off anyway. Yeah. And so in my estimation are probably less likely to file a claim.
Right. Right.
And,
I have
it was almost like the Wild Wild West days. You can do, the insurance companies could do anything basically.
Yeah.
I have a friend of mine who we've talked about. She's
really a friend?
Yeah, she's really a friend. But she would like to get into doing locums, which means that she would have to get her own disability insurance policy. And she had suffered from depression in the past. And her physician literally gave her just samples of lithium, which she never actually really went on. And she's afraid because she's tried to get disability insurance and that has been, either she's been denied or that part has been excluded. And actually, I think she's just been flat out denied.
So
is there anything that you would say to her?
Yeah, in those circumstances, we like to fight it. So I go back to the underwriter. We get a letter of clarification from her doctor saying, here's the deal. These were samples. She never used it. Or, so I always try to fight those. The other thing you can also do, and that's why sometimes it helps to have somebody experienced who's sort of on your side and advocating for you. You can also say, what's the period of reconsideration? They might say, once you've been off meds for 2 years, we'll reconsider you. And then you can apply again. So it's not the end of the world. There are also alternative policies that we get through like Lloyd's of London, Peterson's, that they likely will accept her. So it's a different policy. It's only a 5-year policy, but it's better than nothing. So, and then there's also sometimes association policies. If she's a member of a physician association, she might be able to get. So there are other options that she might be able to have. Okay.
Let's talk about that because I think whether I'm always getting letters in the mail from the American College of Surgery. They have their own disability type of insurance, right? That you can apply for and get. Talk to us about like if you could tier it out, right? Like if you can say like you got your own disability insurance, that's one level. You've gotten something that's through your medical society, that's at another level. And then you got one at your job, that's to another level. Talk to us about, educate us on what's the better one, what's the worst one.
When you're eligible,
Yeah.
when you're not.
How does that work?
Yeah.
So a group policy, sometimes you don't have the option. So because most groups have to have 70% participation. So they really want everybody to sign up, because if they don't get that participation, again, all the unhealthy people are going to take it. The healthy people go elsewhere. So you usually can't opt out of a group policy. Sometimes you can, sometimes you can't. But again, it's not going to be nearly as comprehensive as your individual. Sometimes you just don't have a choice. So that's the group policy.
So that's what you would get at your job.
That's what you get at your job.
You're a resident or you're an attending at a hospital.
Yeah, you
That's
work at
what you would get.
university
Okay.
hospital. They say, here's what we provide you. And
Right.
then you have to sign up. So now some of them say you can also opt for more coverage, meaning you can, we give you X amount if you want to buy more, you can sign up for more coverage. Great option, especially if you're unhealthy, you can get it through your employer. So the benefits of the group is you don't have to answer medical questions. So especially for somebody who has any kind of pre-existing, that's really the best way to go.
Yeah, I do.
Now I get it. Yeah.
So now if you're healthy, you have all the options. The individual policy is going to be the most comprehensive, but it's also going to be typically the most expensive because it's the most comprehensive. And again, there's ways we can price it and put things on or off the policy to try to work with that premium. But that's going to be the most comprehensive, especially because it's got that own occupation definition, meaning you can't do your specialty. It's going to pay you, even if you could do something else. Now, I didn't mention there's really two ways you can file a claim. That own occupation is for total disability. So many other types of claims have what's called a partial disability or residual. And so what that says is you only need a 15 or 20% or more loss of income to trigger a claim. So I've got people right now, they're going through chemotherapy. So the first month, maybe, they're still working, but as time goes on, they can work less and less. So they're not totally out. They're still working, but on a limited basis. They're still able to file a claim. A group policy won't let you do that. It's all or nothing. So that's another reason to have an individual policy. I have people right now, they have carpal tunnel, and so they have to cut back. They just can't work full time. They might have that for years. So again, a partial disability type of claim. So that's why the individual one is superior. Again, you're going to pay more. The association is kind of in between. So it sometimes has own occupation for like 2 years, and then you have to be totally disabled. The premiums are usually less, but they go up every year. So it becomes really expensive. I usually get people calling me in their 40s going, I've had this association plan all these years. Oh my God, I'm paying out the nose. It's not that great. So again, the association could be great if maybe you're a locum and you don't have a group policy, and maybe you can get it through the group. Some association plans don't ask medical questions. So I kind of consider that a hybrid of the two.
Okay. What about someone who they hear this podcast and they're like, man, like I really want to be able to talk to someone about this. But I want to educate myself on this at all also, because, it's like, I liken it to when you go to a mechanic. The mechanic says that, your CV joint needs to be replaced. Like, what proof do you have to say that my CV joint does not need to be
trust?
You've
got to trust them.
Right.
And see, and I don't know what a CV joint is. And so if I'm at a good mechanic, if I'm at a good mechanic, I'm like, okay, do I need to get another opinion, or fine, I'll go with it. So there's several ways. So a lot of clients come to me and they trust me because I've been doing it a long time. Oftentimes they're referred, and I can either walk them through and tell them everything they want to know. Some people want to know everything, and some people just say, here's my situation. What do I do? So there's really sort of the gamut. So we're actually in the process, we're putting together a lot of YouTube videos to really get into the nuts and bolts of all of the insurance, because it depends. You can get as in depth as you want or as generic as you want.
So what are some basics? What are the things that they need to know? Like, obviously the end product, which is what the premium is, they're going to know that. But is there things that they should be asking? Is there a certain amount of coverage that they should be looking for? Is there a certain type of lingo that they need to familiarize themselves with, so that when they talk to you, it's a much easier conversation, or at least something that they feel more equipped with when they walk through the door, or they get on a phone and say, hey, I need X, Y, and Z, and this is why.
So I think one of the biggest questions that I ask people is, how much do you need? And a lot of people don't know. So some of that
Right, right.
depends on their own, because people say, well, what did my friend get? I'm like, well, it doesn't really matter because they might have a totally different situation. It's like asking, well, what kind of house did your friends get? Well, they might have different needs. They might have 6 kids or whatever. So it's really important to figure out for your own self how much you need on a monthly basis. If it hits the fan and you need to replace that income, how much do you need to be able to pay your bills? So when you're looking at disability insurance, you're always looking at it in a monthly benefit amount. So if it's
Okay.
group or if it's individual, it's a monthly benefit. Individual policies are tax free. So you're covering take home pay. There's only a maximum amount you can get based on your income. So you can usually insure about 80% of your take home pay or about 60% of your gross income. Because some people say, well, I make 10,000 a month. Why can I only insure it for 6,000? Well, you're not taking home 10,000 a month. You're paying a lot in taxes. So there's always a little bit of a gap. So a lot of people
Yeah.
forget
Okay.
that. So I think the first question people need to think about is how much do they need to have? Because that dictates how much it's going to cost. So maybe you're eligible for 10,000 a month, but maybe you only need 8,000 a month. You don't need to pay for more than you need. So that's the first thing. And then how comprehensive do you want it? Do you want all of the riders on the policy, or do you just want to kind of have a bare bones policy to cover yourself? And then a lot of it also depends on your situation. People come to us in their 40s and 50s. Maybe they've paid off their debt. Maybe they paid off their house and they just need to get the kids up and out, or they just need to take care of those next 5 to 10 years. So maybe we do a shorter benefit period. So we really try to listen to the needs of the client and help to customize it. So again, I don't want people to overspend on something that they don't need, but they need to be properly covered. So when they come to us, to answer your question, the most important thing is how much do you need to have? So how much you need to have, and then we can figure it out from there. And when it comes to budget, we shop it around, look for all the discounts and say it's going to be between this and this, and help them figure out the best policy.
And so residents should be looking to find out how much they need as a resident, not thinking about as an attending, correct?
So residents can automatically get up to $5,000 a month benefit regardless of their income. And income varies from state to state. So if you're
about $60K a year.
So it's tax free. So that's actually more than what a lot of them take home. So if you've got if you're in the early years of residency or you're doing a really long residency, I usually recommend doing like $3,000 a month benefit. Again, just get a policy, don't overspend, just cover your current take home pay. If you're in your final year of residency or your last 6 months, you can actually get up to $7,500 a month benefit, which is more than your take home pay. So again, it just kind of depends on where you are in residency. There's no need to overspend or overinsure in residency. The whole goal is just to get that policy and capture that discount. Because when you go to increase it, you'll still increase at the discounted rate.
So for all the surgery residents out there, don't go breaking your hands just so that you can make more money.
At least know you're going to have to wait 90 days before you get that money.
Before you get that money, right.
$5,000 a month, they're going to be like, gosh, I was really hoping for a lot more than that. Why did I do this whole residency? So that was a lot of effort for $5,000 a month. So
I do have a question about locums, purchasing your own disability insurance, because you're not, guys, once you go on your own, you're not going to have a group policy. So you're going to have to purchase your own disability insurance, or it's very prudent for you.
As a locum.
Paying for your disability insurance personally, like out of personal funds, or using your business to pay for it. Talk to us about that.
So you want to pay for your disability insurance with after-tax dollars, personal funds, because then the benefits are tax-free at the time of claim. So you're not going to really get much tax benefit by deducting the premiums, but the difference at the time of claim, if you have a $10,000 a month benefit, getting $10,000 tax-free or $7,000 a month or $6,500, it's going to cost you a ton if you have to pay taxes on it. So always pay with after-tax dollars. And another thing is, if you're currently working and thinking about becoming a locum, you're better off getting the policy while you're employed because you have a guaranteed income and you can show that pay stub. Once you go out as a locum, you will have to show an income pattern for at least a year or two. So you might be flying without insurance for a year or two. It's because you need to show that income pattern. Same goes if you're going and starting your own practice. So maybe you're not going to locums, but maybe you're going to be hanging your own shingle, you're starting your own practice. They need to have that income pattern. So if you're employed, you can get your policy. Here's my pay stub. and that policy just becomes portable. Now, let's say you go buy a $10,000 a month policy while you're employed and you go do locums, but maybe you're just working, every other month and you're not even making $10,000 a month. If you go unclaimed, you're going to get paid that full $10,000 a month because you're paying premiums for it. So they're still going to pay that benefit for you because you've been paying for it. They can't force you to reduce it either. So you might even be overinsured initially or over time.
Wow. Okay, that's actually really good to know.
Yeah, and I've had people too that become stay-at-home parents or part-time.
Right.
They work part-time, and so
that's my case.
Yes, so they have a bigger policy. Even if, let's say, I've had people who are stay-at-home moms, so they're not even gainfully employed with a paycheck, and if you go unclaimed, you get paid that full benefit, even though you weren't actively working, because they cannot force you to cancel that policy. So, so at that point, it does become a total disability policy. So I've had people who've had cancer or complications of pregnancy or childbirth or things like that, and it's paid even though they weren't on a payroll.
Yeah, I mean, I would imagine that would be a really big concern for people, who say, well, I just had a child, I want to stay home. How is that going to impact my disability insurance?
Yeah.
So that's actually really good to know.
Yeah.
Now, you mentioned also, people coming to you in their 40s, 50s. We've talked about having even neurological dysfunctions, maybe even Alzheimer's or dementia. And I wanted to kind of pivot, we're talking about disability, but what about when your disability now turns into something that is much more long-term, and you're needing actually care at home? Let's talk a little bit about long-term care insurance, because I know that your company, that Set for Life Insurance, does provide some services with long-term care insurance.
Yeah. So long-term care insurance is sort of a sister product to disability insurance. So the way I look at it is disability insurance covers your working years. When you're relying on your income, you insure your income. So I have a lot of clients that are kind of in that transition period where they're in their 50s and they're kind of letting go. Maybe they're getting ready to retire. But now we're looking at it going, now what's your biggest risk? You've saved for retirement. You paid off all your debt. You have this big nest egg. Your biggest risk is becoming, having, like you mentioned, dementia, Alzheimer's, or some kind of long-term healthcare issue, and it can wipe out those finances. So statistically, 70% of people will have some kind of long-term care need at some point in their life, whether it's nursing home health care, something like that. So a lot of our clients, as they kind of let go of their disability, we're starting to look at long-term care insurance to cover that risk. So that way you don't deplete all of your retirement assets that you worked your whole life to save for. And then on another thing too, is we have a lot of clients whose parents are also, maybe they're in their 70s, 80s, and they're looking at it going, there's our inheritance. Something happens to mom and dad. We're the ones in charge for paying for all of that care. So a lot of the times the siblings all get together and they buy a policy on their parents. So that way they can outsource that risk. So something happens, that risk is covered. Long-term care will pay for all of those needs and their estate is preserved.
Yeah, I think long-term care, and when we talk about long-term care insurance, it just reminds me of a conversation that we had on the podcast not too long ago, where we talked about the Medicaid trusts and things like that. And so sometimes you have nursing home needs for your parents or for yourself. And in order to be able to get that help that you need from the government, you often have to put up your assets. And are people using long-term care insurance to be able to kind of buffer or protect them from having to do that, to basically give up their assets? Like you said, there goes our inheritance. There's the house that we thought that we were going to live in or to be able to rent. Talk to us about kind of the implications of not necessarily having long-term care insurance.
So what you were talking about is Medicaid. In order to qualify for Medicaid, you have to really wipe out that whole estate and the assets have to be minimal, like really, really minimal. So that's really not ideal. I mean, you don't want to wipe out all of the assets to be able to do
Right.
that. So what long-term care, but still, even if your family or your parents still have some assets, it is important to make sure they're covered with long-term care. So I just looked it up this morning. In Colorado, where I live, the average cost of long-term care is $86,000 a year. In New York, it's $100,000 a year.
Yeah.
The average stay
it's
is
expensive.
the average stay is 3.5 years. So if you have mom and dad and they're in New York, you're talking almost $1 million claim right there, just like that. And so that's a lot of life savings, just to, as opposed to, paying for a policy that'll offset that risk. Now, you had also asked about the tax write-off for disability, something very interesting for long-term care. It's the only type of insurance that you can pay for through a business and deduct the taxes or deduct the premiums from your taxes, and the benefits are still tax-free. So that's something really interesting. So if you're a locum and maybe in your 50s and you're kind of thinking, maybe I'm kind of aging out of the disability, but gosh, if I'm rock climbing, I'm doing all these things and something happens, you can maybe pay those premiums through your LLC or through your own business and do something like that. There's also policies that you can just pay for 10 years and you're done and you don't have to pay for them the rest of your life. And that way, by the time you retire, you know that you're going to be insured well.
That's definitely
that is really good to know.
Idea. Yeah.
Long term, you and I had a discussion, Jamie, offline about just kind of long term care insurance. Being in the sandwich generation where you're taking care of your children, but you also could be taking care of your parents. I think that there are quite a number of maybe not so much medical students, but maybe residents who might fall into that, into that particular situation. What is the cost of your average long-term care insurance plan, considering that they're not really making that much money?
It really, really, again, it always depends. But one of the things that you also mentioned, you have residents, chances are they're not even living in the same place as their parents.
Right.
So if something happens, they really literally can't take care of their parents. Whereas hopefully you're living in the same place as your kids to take care of your kids. But if you're sandwiched in and your parents on another coast or something, it's really tough. So the cost has so many different variables. It depends on your age. There's also discounts if you're married. There's discounts if you're healthy. Depends on how much you want to pay for all, do you want to have different riders on the policy? But just for an example, like I had a client of mine, he's 50 and he's in that period where he's thinking about transitioning out. For him, it's like $150 a month for just sort of a starter plan and just to have that. If he wanted to have the 10-pay plan, it was like $6,000 a year. But in 10 years, he's paid up. He could do it. He's a locum physician. The older you are, the more expensive it is. If you wait until you're 70 or 80 to buy a policy, it's very expensive. It could be $1,000 a month or something very, very expensive. It really, again, it just depends. And sometimes you don't cover the whole risk. You just say, we're just going to cover a portion of it. We can't afford the full amount, but the kids are going to just chip in and get some for mom and dad. Yeah.
This is actually a big deal because I know it's being brought up in the political scheme or political
scheme
right now. I'm from being from Ghana, but scheme, whichever way you want to look at it.
It's in the conversation. And if you look at the demographics, the population's aging. And so the younger generation are not having kids and the population's aging. I read something, I think by the year, don't quote me on it, in about 20 to 30 years, 1 in 3 people will be over the age of 60. Like it's really skewing there. And so what is that going to do to the long-term care community, the nursing homes and the cost of the care and everything? So we're entering some uncharted waters in this. And this is not covered by Medicare, maybe Medicaid, like you said, if you deplete all your assets. So, and there's been a lot of changes in the marketplace. So companies have come in, come out, they're not having priced it right. So there's still some shifting around that's happening.
Yeah. Well, listen, so if folks want to get in touch with you afterwards, they want to continue this conversation. They're like, look, that's the person who has a heart of a teacher. I want to talk with her. How do they get in contact with you?
The best way is just to go to our website, setforlifeinsurance.com. Our contact information's in there. We have a calendar link if you want to set up a time. We have a request a quote if you want to request quotes. If you already have insurance, like you did when you came to me, I'm happy to review that too. Sometimes I say you should replace it. Sometimes I say you shouldn't. I'm very straightforward, and I always look at the best interest in the clients.
Yeah, we're going to have that link in the show notes down below for those of you who are, really interested in either disability insurance or long-term care insurance or life insurance, because you do life insurance
We do a lot
as well.
of term life insurance. Yes.
Yeah.
You guys heard that term.
Term life, not whole life.
Yeah, but I think there's it's always available. That's whole life is always. You guys do whole life, right? If it's necessary.
Not very much.
Needed.
In very extenuating types of circumstances. My philosophy is you want life insurance. You want as much as you can get and pay as little as possible until you're able to self-fund. Maybe the kids are out of the house or you've paid off everything and you really don't need it anymore. That's the goal for term life insurance. You want to cover it while you're vulnerable and not overspend for it.
Right.
There it is. Boom. Hey, Jamie, thank you for coming on the show and kind of schooling us on things that obviously we didn't go to school for, but we really appreciate it. And we also appreciate the partnership that you've had with Docs Outside the Box for all these years. And for the folks that are listening, listen, we have worked with Jamie for close to 10 years now.
Yeah.
And, we are very happy with this relationship and it's moved on into this podcast. And I do believe that there's, you want to work with people who have a heart of a teacher. You want to work with people who have your best interest in heart. And depending on where she is, she might be up here or here. Jamie definitely has it. So make sure you guys check it out. Don't be afraid to even just start the conversation, even if you're just a resident. Okay. It can never be too early. Just have the conversation. Yeah. And obviously, if you're a young attending and you've left residency and you're wanting to know, just, pick up the phone or send an email and have that conversation.
Yeah.
Well, thank you guys. I've really, truly enjoyed being on the podcast and getting to know you over the years and seeing the pictures of your kids over the years. They are just adorable. And hearing their stories as well. So thank you so much for having me on.
Thanks so much, Jamie.
Thanks.